Welcome back to my channel, to another 5-minute Friday video where I always try to give you guys valuable information within a short span of 5 minutes. If you're new here and want to know why I'm making these 5-minute videos that don't seem very long or helpful, you could check out my video over here somewhere. So I actually have a friend who recently texted me asking out of the blue how he can grow his wealth in Singapore with as little risk as possible. So just to clarify, this isn't financial advice, it's just my personal opinion. But I have compiled a list of ways that I think are most sensible when dealing with your money. If you want to grow your money in Singapore with moderate risk without basically risking your career or losing all your money, I think this is the right video for you to be watching. Some of these I've tried out, some I have not, but I think these all provide asymmetrical risk to reward ratios. So it's definitely worth considering any of these options if you want to try growing your wealth. I'll also try to explain how to do it right so that in no circumstances will you ever go bankrupt or go broke. Anyways, if you're new here, my name is Gaius. I'm a Singaporean waiting to study at the National University of Singapore. I'm still a student, so don't take everything I say to heart or don't take it too seriously. Do your own due diligence before doing anything with your money. Anyways, let's hope this video will end in 5 minutes and I'll start now. Okay, so for this video, I actually will be referencing my iPad because I don't want to say anything that is outright wrong, so I've tried scripting this video out more thoroughly. So first, let's get stocks out of the way because that's the one that, is most commonsensical and makes the most sense for most people. If you are financially literate, you would already know about exchange traded funds as well as the 4% rule. So I'll just explain it briefly, and if you wanted to, you could probably read more videos or You could probably watch more videos or read more books about it yourself. So the 4% rule basically states that if you are invested in broad market index funds, it's likely that you could withdraw 4% of your portfolio every single year and have your money last forever, perpetually, basically. Generally, these broad market index funds will return somewhere between 7 to 10% per annum in the long term. This means mathematically, after taking into account fees and stuff, 4% withdrawal from your portfolio should be relatively safe, even though this is something that's still debated on financial forums. Okay, so I just wanted to throw in my personal view on this. So I think that even if you choose to retire early after you've had a large amount of investments, it's likely that you will still be doing some form of work. So the margin of safety is actually probably larger than expected. For instance, if you teach tuition 2 to 3 days per week, it is actually possible for you to earn about 1,500 per month, and if you are living a modest lifestyle, that amount of money is actually enough monthly, especially since you're retired and you have much lower expenses. But yeah, that's just my own personal opinion. You have to think for yourself whether this approach will work for you, or if you have a higher margin of safety before you choose to retire, right? Like account for the fact that you might withdraw more than 4%. So how do you grow your wealth with exchange traded funds? Basically, you create a brokerage account and you start investing regularly into these exchange traded funds. And eventually you might come to this point where you're financially free. So this is what people refer to as financial independence, retire early. There's an entire movement, an entire subculture of people who subscribe to this methodology of reducing your expenses and increasing your income, and then investing as much as you can into exchange traded funds, so that way you'll be able to retire early and safely. I think this is the most conservative way to grow your wealth, and it's also one of the safest. And for that, I recommend everyone at least try doing this method partially, because it's one of the best risk to reward ratios out there. So when you reach the retirement age and you're actually retiring, it's probably wise for you to sell some of these exchange traded funds and buy bonds instead. So that lowers the volatility of your portfolio and also lowers your risk profile. This is generally the safest way to invest. I recommend that 50% of the money you invest should go into exchange traded funds like these. I'll put them up on the screen, especially if you're Singaporean. So there's a bunch of more tax efficient exchange traded funds listed on the London Stock Exchange that have lower expense ratios. So I'll put them here. If you're Singaporean, this would probably be your exchange traded funds of choice, but if you're not, then you might have to do your own due diligence. The rest of the money you could probably use to speculate on individual stocks. So you could invest in meme stocks that have enormous upside, but could go all the way down as well, or you can invest in companies that you truly believe in. So this is where learning how to be an active investor or maybe a value investor or whatever investment strategy you believe in would come into play. Still, it's very unlikely for a person who stock picks to actually succeed long term. So try not to get too greedy, try to stay emotionally grounded and have the majority of your portfolio be in exchange traded funds that are safe and almost guaranteed to grow and give you long-term returns. Okay, so next, businesses. So achieving financial independence using a business usually entails either hiring people to outsource the entire process of your business so that you don't have to be involved in any way at all, or building a crazy unicorn startup company that you then sell and get a large sum of money from, and then after that you could use that and the first method by investing in exchange traded funds to retire early. So it's either you build a company and you automate it so that you get cash flow every month, or you sell the company, get a large sum of money, and then use that to retire. So the former is actually a lot more realistic than most people think. To ensure that you're not taking any real risk when starting a business that could potentially bankrupt you, it's ideal that you start a business which has the lowest burn rate possible. In other words, the monthly expenses required to sustain your business should be kept as low as possible. So one way to do this is to start a company that sells services rather than products, because that way you don't need to have certain things that you would if you were starting a company that sells a product. So you don't need inventory, you probably don't need a real shop space, and like you don't need a physical location. And that would lower your cost drastically because the cost of having a physical location is extremely expensive. And taking on any inventory also means you're taking on more risk, because if you fail to sell the product, then the inventory is just stuck there and you can't do anything with it. For instance, you could start off by thinking of yourself as self-employed. So while working a full-time job, you could teach private tuition on the side. And eventually, when you have enough students, you could hire someone to teach some of your students for you. So that would be outsourcing your business, and gradually you might build a tuition service where you hire tutors to teach students that you've amassed over the years. This literally costs you no money because you can teach group tuition at your own house. And there are also agencies that allow you to find students where they don't actually take any money from you upfront, but instead take half of your first month's wages. So the only thing you stand to lose is time. Like I said previously, once you have sufficient funds and perhaps sufficient number of students, you could consider hiring tutors to teach some of the students for you and even getting a physical location and starting a tuition center. You could also further enhance this stream of income after becoming relatively well-known in industry by writing assessment books, or maybe even writing normal books where you sell to your students, and perhaps even try to get published and sold in bookstores in Singapore. So another example of a few businesses with a really low burn rate could be something like a YouTube channel or a 3D printing studio of some sort. So to start a home-based 3D printing studio, you probably just need to buy a 3D printer. I don't know too much about it, but you could probably charge people a fee to use the 3D printer in your house. So they would do the designs and everything on their own, and when they want their designs to be printed, they just need to mail it to you and you charge them a fee for printing it for them. So that's a business with relatively low burn rate because you buy the 3D printer, you keep some cartridges at home, and when business comes in, you make a small profit. Similarly, for the YouTube channel, all you need to do is buy a bunch of gear, which I've done. So you just need to buy a decent quality microphone, a decent quality camera, and perhaps a decent quality light. And try to, make your background look relatively nice. And you can film YouTube videos every single week. So this has a potential to scale, and you could possibly earn ad revenue someday, or even maybe sponsors and stuff like that. Of course, this is a business that is like, the chances of succeeding on a YouTube channel or like a home-based printing studio and making it big is relatively low. However, because there's this asymmetrical risk to reward ratio, if you do it consistently enough and constantly try to promote yourself, whether it's through going into the enthusiast subreddit and like making comments about your 3D printing studio, or like making YouTube videos that deliver content consistently and hoping the algorithm helps you out, these sort of low burn rate businesses usually require no upfront investment other than your time. Same thing for the tuition center and tuition services thing. If you continue amassing students and then perhaps after that asking them whether they would be willing to take a group class instead of one-to-one tuition, and then hiring tutors to outsource that portion of your business, you will be able to achieve quite a lot of business growth with relatively low risk. So the third way I wanted to talk about is property investment. This might be the most risky out of everything on the list, but if you're staying with your parents and you already have a place to stay, buying a second property and renting it out can be a good way to increase your wealth. Of course, properties are expensive in Singapore, so the way you would probably want to go about doing it is to actually take a bank loan and buy a second property. This is risky. Let me emphasize that. The reason I think why this provides an asymmetrical risk to reward ratio is because buying a property loan is probably the cheapest type of loan you can get in Singapore. Also, if you have a partner who can afford it, you could try getting a HDB together. Like, let's say you have a partner, you could still try doing property investment. When you and your property BTO or get your HDB flat, if your partner's salary is high enough, you could request that your partner lists you as an occupant while she remains the sole owner of the HDB. That way, you can actually go and buy a condo by taking a bank loan on your own. without incurring additional buyer stamp duty, which I think is the main reason why most Singaporean couples don't try to buy a second property. Even if you're not in such a privileged position, what you could do is consider renting out a few rooms in your home. So this is a very safe form of passive income, and it's a very safe way to grow your wealth because you increase the amount of money you have. That money then could be invested into exchange traded funds like mentioned previously, which will help you grow your wealth sustainably and relatively safely. Or of course, you could use the money you gain from there to try and start a business. Ideally, if you're buying the second property, you want first of all, to manage your risk, you would want to make sure that you're actually able to pay it off even if the property price doesn't go up and even if you can't find any tenants. Because buying a second property doesn't guarantee that you'll be able to find a tenant. However, the idea here is to put your money into assets instead of spending it so that at the very least, you have a chance of growing your wealth. So the worst case scenario here, if you do this right, is probably that you buy a second property and the property just sits there. So you want to only buy the second property if you can actually afford to buy the second property and take the bank loan without negatively like putting your cash flow into negative every single month. In other words, you don't want negative cash flow. Your salary should be enough for your monthly expenses as well as paying off the bank loan. Of course, this is just in case you can't find tenants. Chances are you'll be able to find a tenant eventually, and the rental income you collect from the tenant will either offset the cost of the property or offset the cost of the property partially or completely. So ideally, if you're buying a second property, you want to aim for one that has at least 5% rental yield and hopefully positive cash flow, which means that hopefully the amount of rent you collect each month is actually higher than the amount you need to pay for your mortgage. You also want to pick a property that is likely to appreciate in value. So one of the ways you can do this is by looking at the something something master plan, which details the development activities the government plans to pursue in the next 10 years or something like that. So the two ways you could potentially earn money from this is, number one, of course, when you buy the property and if you manage to find a tenant who offsets the entire cost of rental income, you're basically getting a free property, and then after that you can rent out the property for additional cash flow once it's fully paid off, and that will be like passive income. The other way is to buy the property and sell it, and you earn the capital gains plus the amount of rent that the tenant has offset for you. Right? The amount of the mortgage the tenant has offset for you. I'm sorry that I'm rambling. It's kind of tough because I'm not actually an expert on this topic, but my friends have been asking me about it, and this is roughly what I think and what I would try to do in future. So hopefully this video was helpful to you guys too. Lastly, I just wanted to reiterate again, finding tenants can be difficult. So you want to make sure that you can actually afford the second property even without getting a tenant. So basically you want to be able to buy the condo without actually having a tenant. And then after that, treat it as a bonus if you're able to rent it out. So buy a property that you think will appreciate in price, and then after that try to get a tenant to offset the cost of the property. So if you can't afford to do this, consider renting out a few rooms in your house, and also try reducing your expenses further and increasing your income so that one day you could be able to consider doing this. You still need to pay a pretty hefty sum for the down payment, so you do need to save up some money before you could do this. But yeah, I think this is quite a good way to leverage, right? Instead of like borrowing money and trading on margin for stocks, it's probably safer for you to borrow money to buy a second property if you want to use borrowing money as part of as a strategy to grow your wealth. Okay, so I'm actually recording this after I filmed the outro because I forgot to add some things I wanted to talk about. So I actually think that complete retirement is extremely boring. Like retiring completely might sound like a good idea at the start when you're working and you're really bored and you hate your job, but I think most people will actually end up finding retirement to be very unfulfilling if you don't plan ahead. I would actually recommend that you do this thing that people on the FIRE subreddit call barista FIRE. So if you want to retire with a lifestyle of $3,000 per month, instead of waiting till you hit $1 million based on the 4% withdrawal rule so that you can retire a lifestyle of $3,000 per month using traditional FIRE, you could sort of get to $500,000 and then withdraw 4% of your portfolio every month, so that which gives you about $1,500 every month. And then after that, perhaps work 2 days a week teaching private tuition to earn, another 1.5k, so that in total you have $3,000 per month to spend. You have the freedom of time that is usually what you desire, and you also have something to look forward to doing every single week so that you still feel like your life has some sort of purpose. Complete retirement might sound like a good idea, but from what I've read, most people don't seem to think it is once they've achieved it. They seem to enjoy doing some sort of work or finding some sort of work to do. And I think if you're going to be working anyways, you can start your semi-retirement much earlier than you think you could, because you don't actually need to wait that long to start this sort of lifestyle if you're going to be making money on the side that can fill your expenses anyways. Of course, there's still some amount of risk, but the worst case scenario here is that you go back to working a full-time job for a few years and build your portfolio again before you go into this semi-retirement again. So I don't think it's that bad, even if you end up depleting part of your invested portfolio, and because of that you have to go back to find a full-time job. Yeah. Also, if you really want a like margin of safety, you could consider setting your withdrawal rate even lower than 4%, which means you need to recalculate the portfolio value you need to retire in the first place. So yeah, I think that's all I wanted to add. Hopefully I didn't miss out anything, because re-recording is honestly really really boring, and I couldn't even be bothered to put a microphone on the stand. So yeah, thank you guys for watching. You'll see the outro now, I guess. So yeah, hopefully that was within 5 minutes. Honestly, this could have been a long form video on its own. I could have made it into a long video, but I really didn't feel like filming a long video this week. So this is just a quick video, 5-minute Friday. Hopefully it's within 5 minutes that I could quickly push out and keep the algorithm happy, and hopefully also provide some value for you guys along the way. Anyways, if you'd like to see more 5-minute Friday videos, click on this playlist somewhere here. Hopefully I'll have more videos uploaded by then. If not, thank you so much for staying till the end. Hopefully you consider liking or subscribing, and I'll see you next week.